You are watching Darasa Online.
Hello students, welcome to Darasa Online. I am Remas Hassan, a teacher of commerce. Today I will be with you in a revision of a topic, insurance, and in this topic I'm going to cover 3 subtopics. The first one is concept of insurance. The second one is principles of insurance. And the third one is insurance and gambling. Now, my dear student, by revising, what is insurance? Insurance is the system of pooling risk together in the common pool, which will be used later to compensate those who will suffer the loss from the risk insured. After revising on the meaning of insurance, let us move to concepts of insurance. In the concepts of insurance, we are going to revise on 2 things. One is the importance of insurance, and another one is classes of insurance. Starting with importance of insurance. Insurance has got many importances. The first importance is compensation. The insured, after he has contributed his premium to the common pool or to the insurer, in case the risk that he has insured will occur, then he will be compensated. That is, he will be returned to the original financial position that the one he has before he suffered the loss. Another importance is that insurance is a means of saving, or it acts as a means of saving. By acting as a means of saving, what does it mean? This means that an insured, after contributing his amount to the common pool, after a certain period of time, when his insurance policy matures, then he can get some money from the insurance company. And this happens to the case of life insurance. In life insurance, the insured can insure his life for a certain period of time, say 20 years to 30 years, or he can insure his life for the whole period that the one he will be living. And when the time reach, if it is say 20 years, then the insured can get money from the insurance company. Another importance is that generation of income to the government. By generation of income to the government here, it means that for all insurance agencies or firms, including national insurance company, in their operation, they used to pay taxes to the government from time to time, following the trading activities that the insurance companies are doing. And these taxes which are paid to the government are income to the government. Insurance also promotes trade activities. It promotes trade activities. What does this mean? Individual companies, institutions, individual persons can perform their business activities freely without fear, both internally and externally, since they are sure of being compensated in case of any risk. Say, if the cash is lost or is stolen, then they can get back the money. But also, if fire take place and goods are fired and distracted, again, they can be compensated. Employment. Also, insurance provide employment to those who engage themselves in insurance activities. So through insurance companies or agencies, then we find that people are employed. Promotion of specialization. Also, insurance promotes specialization. By promoting specialization here, it means that while other firms are working in other institutions like transportation institution, communication institution, banking institution, then we find others are taking part in insurance, so they specialize in insurance activities. So we say there is a promotion of specialization. Another is investment. Investment here, the money so collected can be used to invest in various ventures, business ventures. Like housing. So the money can be used to erect structures or to build houses. When the houses are built, then they can be rented and money can be obtained from such activities. After seeing the importances, let us move to classes of insurance. Now, insurance is classified into two classes, which is property insurance and life insurance. Now, my dear student, in some question which are posed to you may use the word classes, but sometimes there is other related words which can be used different from classes, and in case it happens that such terms are used, my dear student, don't be confused, but you should just know that they are the question is meant the classes, and those terms, let me mention or identify them to you. One is branches. You can find the word branches of insurance, it means classes. Another term is types. Types of insurance, this will also mean classes. But you can find another term used, categories. Categories of insurance, also this will mean classes. So if you find these terms, don't be worried, but use them to explain the classes of insurance. Now, property insurance is again subdivided into three sub-branches. One is accident insurance, fire insurance, and marine. And accident insurance is subdivided into two. That is motor vehicle insurance and general accident insurance. Property insurance, this refers to insurance that covers the losses or damages that take place on properties or goods like houses, furniture, warehouses, and so on and so forth. While life insurance, this is the insurance that covers the losses or damages that take place to the life of a person. So the life insurance, it is about personal life. It covers the life of people. Now, under accident insurance, we say this covers all misfortune that take place due to accidents, various accidents that may take place. For instance, for motor vehicles, this means when the motor vehicle collide with another motor vehicle, but also you can get a motor vehicle collide maybe with a train if it passes somewhere where there is train, also it's an accident. For fire insurance, here it means it covers damages and losses that happens to properties due to fire incidences. And marine insurance, this is insurance that covers the loss or damages that take place in the oceans and in the sea, especially in the high sea. So when the ships are traveling from one continent to another continent or from one place to another place, they can either collide with another ships, or they can sink, or they can get any other problem in the sea, and therefore marine insurance will cover all this. After we have seen these classes of insurance, now let us ask ourselves a simple question concerning the insurance of these items, properties and goods and life and things of that sort. Can an insurer insure all types of risks? Question. Can an insurer insure all types of risks? Now, insurer cannot insure all types of risk. There is risks which are insurable and risks which are not insurable. Now, my dear student, in order the risk to be insured, the loss that take place on the property must, in order to qualify to be insured, should be foreseeable and or predictable. And the loss should be, or the event should be predictable or foreseeable, and that can be calculated in mathematical terms. The risk which is insured also, in order to qualify or to be to qualify to be insured, the risk should be spread over a large number of people. So you cannot insure a risk which those who want to take insurance for such a risk are few, as the insurance bears on the law of large number. So it requires large number of people to contribute and make payment to those who suffer. Another thing is in premium. The premium which the insured will have to contribute to the common pool must be within reach. Therefore, we want as many people as possible to contribute to the pool, and also to compensate them when they get, when the insured risk happen. Now, therefore, we need also the premium to be paid by these people or this insured should be within reach so that they can contribute. The policy holders are supposed to be geographically spread, or they should cover a big area, a big geographical area. Geographical spread or cover a big geographical area. The policyholder, when taking insurance or when providing these insurance services. In order to be able to perform the service of compensating, these people should not be located in just one area, since if the problem of fire, if the event insured is fire, if the fire take place, it means many houses and many properties will be burnt at a time, and the insurance company may fail to pay. So when the risks or the policyholders are geographically dispersed, it means in case of risk occur, it cannot occur in all areas. So, my dear student, after we have seen the risks which can be insured, now let us proceed with principles of insurance. Now, we have several principles of insurance. The first one is now, my dear student, we have about 6 principles of insurance. One is utmost good faith or berima fides, indemnity, contribution, proximate cause, insurable interest, and subrogation. So we have these 6 principles. In our revision now, let us see what are these principles and how the insurance company uses these principles. The first one, which is berima fides or utmost good faith. Utmost good faith principle requires the insured to submit to the insurance company all the material facts concerning the subject matter. That truthful, the insured must be very trustworthy in providing the information concerning the insurance that he wants to take. Now, for the case of property, the information required here will be value of the subject matter, location, where it is situated or it can be found, description of the property, sum insured, the amount that the insured want to insure, type of insurance cover, type of insurance cover. Here it can either be comprehensive, or can be life, can be property, fire, comprehensive, etc., etc. For the case of life, if one wants to insure life, also he has to provide the information, material facts. The first is one has to provide the information concerning the birth date, evidence. Also, health status of the person taking insurance must be known. Again, lifestyle and habit. Life history of the one who is taking insurance also. The insurance company will need to know so that it can use this information for insurance decisions. So all this information are provided for two reasons. One is they are significant for decision making, and for premium calculation. So all this information will be used to make decision on making. Okay. My dear student, let us proceed with another principle, which is indemnity. What does the indemnity principle states or says? This principle, it requires the insurance company or the insured to compensate the insured up to the extent of the loss he has incurred, or the actual loss suffered, and not more than what he has suffered. So, under indemnity, the insurance principle, this means that the insurance company is not intending to benefit any insurance taker, but it needs to restore the insured to the original financial position that he was before he suffered the loss. Now, factors which are considered when insurance company want to indemnify the person are: one, sum insured. Sum insured, this is used as a factor to compute the amount to be indemnified to the insured. So it's an important base that we need to know the value of the asset that has been insured. Wear and tear. Before an insured is compensated, the amount of depreciation for the asset is computed, and this is done so in order not to benefit the insured or not to exploit him or her. Market value is another important factor to be considered, and in this market value, the assumption is that the market value of an asset is the price of the asset in the market at a given period of time. So here we look at if this asset, which has undergone loss, if it was sold, how much money would be received from the sale of such an asset. Degree of destruction. This is another point that has to be considered before an insured is compensated. That the actuary or the officer of the insurance firm or company has to visit the site or has to inspect the item that has been destructed and assess the degree of destruction before the insured is compensated. Now, after all this are done, what are the ways that can be used for compensation? One is the first way of compensating the insured is to give him cash equivalent to the loss suffered. So after the assessment, the actuary will come up with the figure or the amount that is supposed to be compensated, and he can be paid by using cash. Another way of compensating the insured is repairing the asset or the subject matter. So an insurance firm can take the responsibility for taking the asset, if it is a motor vehicle, to mechanical offices or garage, taking the asset to the garage and repair the asset or the motor vehicle. And another way of compensating the insured is reinstatement or replacement. If the asset is wholly damaged, that it cannot be repaired, then the insurance firm will take the residual value or the asset, what is remained from the accident, and thereafter it will give the insured a new motor vehicle. Now let us look this contribution. And contribution here, contribution refers to where the insured has insured his asset in more than one insurance company. Then if the insured risk happen, then the insurers will contribute proportionally towards the loss that has occurred. Proximate cause. This requires for an insurance company to compensate to the insured. It requires that the risk occurred, it requires that there should be a close relationship between the risk occurred and the event which has been insured. Take an example that you, an approximate cause, you insure a house against fire. Now, if you insure the house against fire and approximate cause, there should be a close relationship between the loss occur and this fire or the event that has been insured. And here, to be insured, the cause should be ignition. Ignition. So, if there was no any ignition or lighting, maybe there was thieves who entered the house, and in the process of stealing, then they caused fire to the house. The immediate cause of the loss is not fire, but it is theft. The insured must own the property. To own the property, it means that if the event insured will occur, then he will suffer the financial loss. So anyone who wants to insure an asset must be owning that asset, and by owning that asset, it means he will suffer financial loss if the risk insured occurs. Now, if any person has got a financial claim against another, or a right of support, or a right of support or maintenance from the other person, then this person can insure the other person. This means that the following have insurable interest. A person, my dear student, you as a single person, you have unlimited insurable interest with your life. Myself, I have an insurable interest with my life. Therefore, I can insure my life. Also, a son against his father. A son has got insurable interest in the life of his father. Why? Because he is depending on his father. So if his father died, it means he will be suffering, as he has official dependence to the father. Therefore, the father can insure the life of his son. A wife against her husband. A wife has got insurable interest against her husband. They have official relationship, and for that case, each of them can insure the life of the other. Also, a creditor has got insurable interest against the life of the debtor up to the extent of the debt that he owes him. So, after we have seen the insurable interest, let us move to subrogation. Now, the last one is subrogation. Under subrogation here, since the insurance company does not aim at benefiting the insured, then in case of full compensation, if the insurance company compensate the insured in full, therefore the remainder of the asset which has been destroyed will be taken back by the insurance company. So this subrogation principle means that no insured person who will remain with the item which has been destroyed after full compensation. Now, my dear student, let us look at the question, the first question on the principles of insurance. My dear student, we have revised on principles and we have seen how we have seen the informations which have to be provided to the insurance company and things of that sort. Now let us look at a question, a guiding question number 1. We have a question here. Insurance business has the principle which govern its operation. Show the relevance of the principles to both insurer and the insured. What does the question wants you to do? That the insurance business has the principles which govern its operation. Show the relevance of the principles to the both insurer and insured. This question, when you look at it, it wants you to tell the relevance of the principles to insurer and insured. The relevance, what does it mean? The importance. How are they used? Now, as we have seen various principles, take an example of utmost good faith. What is the relevance of this principle to the insurer and insured? Here, we saw that this principle requires the insured to submit all the material facts concerning the subject matter. So this principle will be used by insured to identify the information which are required by the insurer and file all those information concerning the subject matter. But the insurer will use the information which has been submitted to him to calculate the premium, but also will use the information to make his decision concerning the insurance that the insured want to take. But for indemnity here, the insurer will make sure that he has got all the necessary information concerning the subject matter, so that whenever he is making compensation or payment, he does not overpay the insured. So this indemnity will guide the insurer not to overpay or to overcompensate the insured. And at the same time, the insured will use this principle to make sure that whenever he wants to be insured, he should consider the value of the property so that he will not underinsure, that he will not insure less amount, or he will not insure more than the value of the asset. Insurable interest. Here we see that the one who insure a property must have a close relationship with the property that he wants to insure. So a person will insure the property that he owns, and also a person will insure his life, or will insure the life of a father or a mother, and not otherwise. Now, my dear student, I've explained 3 principles. I have shown you the relevance of 3 principles. You can do the same for the other principles, that you have to understand the principle, what it requires, and show how the insurer will use it and how the insured will use it in case the event insured occurs. My dear student, we have another question on the board. Regarding question number 2, Mr. Ruhusa has decided to insure his friend's house to save him from the risk of fire, basing on the principles of insurance. Explain to him on why his decision is not accepted. So, Ruhusa has insured his friend's house to save him from the risk of fire, basing on the principles of insurance. Explain to him on why his decision is not accepted. So, my dear student, you will see here this issue of insuring somebody's property. How does the insurance company consider? Now, this is under the principle of insurable interest. Under insurable interest, one cannot insure another person's property. So since Ruhusa is not the owner of the house, he cannot insure the house. When the event of fire occurs, the insurer will assess the loss and also will require to know the owner of the house, and if it will find that Ruhusa does not own that house but it is the house of another person, he will not be insured. Another question, my dear students, we have another question here which says, business students at your school are planning to conduct a debate with the motion insurance and gambling are similar concepts. As a class member opposed the motion. So, my dear student, what does the question want? It wants you to say that insurance and gambling are similar concepts. Do you agree, or you don't agree? Do you side with the motion? Oppose the motion? That means insurance and gambling are not similar. Let us look at the concept of insurance and gambling. This will be it is our third subtopic here, insurance and gambling. Now, in insurance, there is insurable interest. When you want to insure any property, you must have an insurable interest. But in gambling, there is no insurable interest. Now, in insurance, there is no loser, or there is no loss or gain. But in gambling, there is loser and also there is profit. Here it means that once one contributes his money to the common pool, here it means that he gets protection. But when one put his money to the betting shops, he either get profit if he win, or if he does not win, he lose. Also, there is the issue of principles. In insurance, insurance obeys insurance principles, so it follows principles in its operations, while in gambling, there is no principles. Operations are done honestly. But for the case of gambling, there is dishonest. There is dishonest, that there is a lot of cheating and other behaviors which are not very honest. Another thing is that insurance provides employment. Insurance provides employment, or it promotes employment, but gambling promotes idleness. So you'll find that many youngs nowadays and some few older people, elders, they are not working as required. Instead, they are trying to bet in order to make quick and easy money, and something which is very dangerous for the development of a nation. Another thing is Another thing is that insurance it helps the businessman. So it's a blessing to business people or society. While for the case of gambling, it is a curse that is opposite of blessing. And also it creates chaos to the community. If you find children are stealing money from the family, or they diverge their funds to betting. If a student, assume a student is given pocket money or is given money for paying school fees, and he used the money to play or to gamble, then you find that this is a chaos to the society. So through these points, we can conclude that insurance and gambling are not similar, and also have got a positive effect to the society, while gambling has got a negative effect to the society. So, my dear students, let us proceed with another question. We have another question number 4 on the board that reads, Mr. Jengo aimed to benefit from insurance company by over-insuring his house against fire. According to the insurance principle, will he succeed from his plan? So, my dear student, Mr. Jengo has over-insured his house. Can he succeed from the plan? Now, since we said that the insurance company does not aim at benefiting the insured, therefore it's definitely that Mr. Jengo cannot succeed to his plan. What does it mean by over-insuring? Now, over-insurance refers to the act of overstating the value of the subject matter or the property to the insurance company. So, when submitting the information concerning the subject matter, Mr. Jengo, he submitted an amount which is over and above the real value of the property. And by doing this, it means that if you overinsure your property, it means that also you'll pay more premium. So you'll pay greater premium than if you could submit the actual amount of the actual value of the property. Now, assume that Mr. Jengo has the value of the property. Assume the value of the property is 800,000, and the sum insured is 1,200,000, and amount of loss is equal to, say, 600,000. Now, to find the amount of claim, is equal to sum insured over value of the property times loss times loss occurred. Now, the sum insured for this case is 1,200,000. So if you take claim is equal to 1,200,000 over value of the property, which is 800,000 times amount value of loss is that much. Therefore, this one is equal to 4,342. This one is now if the sum insured is 1,200,000, Mr. Jengo is expecting to get 900,000. But since the real value of the property is 800,000, in case of total loss, the amount to be claimed is supposed to be 600,000 shillings and not this one, not 900,000. So by overinsuring, it means that Mr. Jengo will pay more premium, expecting to get a big amount of money if the risk insured occur, but in the real sense, if it occurs and the insurance company does not want to benefit the insured, then he will only be compensated up to 600,000. So, my dear student, thank you for following. It's my hope that now you are able to explain various concepts concerning insurance as far as classes of insurance are concerned. You can identify various classes of insurance, but again, you can explain various principles. You can apply them, the principles of insurance, in your answering questions, but also after your completion of Form 6, you can advise many Tanzanians, but also you can start or establish an insurance firm and assist traders in their dealings. Now, my dear student, I have an exercise for you. Take note of this question on your notebook and go through them. The exercise reads as follows. Examine how the following terms are used in insurance. The first term is reinsurance and another term is mitigation of loss. And item 3, through the principles you have learned, apply them in insuring your property and show the effect of the principles to insure. So do this task as an exercise. Thank you. Till next period.